So what's the better move, real estate or stocks? You know the debate, right? One person swears by their rental property. The other is all about index funds. And honestly, both of them are probably convinced they made the smarter choice. But what if we could, actually run the experiment for real? Let's do it. We're going to follow two identical people for 20 years and see who really comes out on top once you count every single dollar and every single stressful hour.
All right, so here's the game plan for our little 20-year experiment. We're going to follow our two guys, Jake and Marcus, through all the ups and downs, from that first rush of excitement all the way to the final verdict. We'll see how that one big decision at the beginning ends up shaping, well, everything.
Okay, first things first, let's meet our two investors. And look, to make this a fair fight, a really fair fight, we have to start them on a perfectly level playing field.
So, on one side we have Jake, and on the other, Marcus. Think of them as financial twins. They've got the exact same $50,000 in savings, they earn the same salary, same age, same city, everything is identical. The only thing that's going to be different is the choice they're about to make with that 50 grand. All right, so Jake, he goes for something he can touch, something tangible. He takes his savings and puts it down as a 20% down payment on a $250,000 house. Gets a mortgage for the rest, and you know what? On day one with the keys in his hand, he feels like he's already won. He's got a tenant lined up, a cool story to tell at parties, and a physical asset he can actually drive past and point to.
Marcus, on the other hand, takes a, let's say, less glamorous path. He puts his 50 grand into a simple stock market index fund. Just betting on the long-term average market returns. He even sets up a small, automatic $300 a month investment. And what does he get for it? A confirmation email. Yeah, nobody at that dinner party is going to be impressed with that one. It just feels so abstract, right?
Okay, so let's jump into the first few years and see how this all starts to play out. Because this is where that initial feeling of, hey, I'm a genius, really gets put to the test.
Now, for the first 3 years, Jake is feeling pretty good. He's collecting rent, paying his mortgage, and on paper, things look fantastic. I mean, he's pulled in nearly $17,000 in cash flow. He feels like an absolute genius. But that's the on-paper number. That's before reality decides to show up.
And yet, this is the part of the story that most real estate gurus kind of forget to mention. Beyond that mortgage payment, you've got property taxes, you've got insurance, and then the inevitable stuff breaks. The water heater goes out, the roof starts leaking, and of course, a tenant moves out and suddenly the place is empty for a month. These aren't like once-in-a-lifetime disasters. This is just the normal, predictable cost of being a landlord.
And just like that, poof, that nearly $17,000 profit shrinks all the way down to about $3,000. That's the real gut drop moment, isn't it? All that work, all those phone calls, coordinating repairs, and it averages out to just $1,000 a year? Wow.
So what about Marcus in the meantime? Well, while Jake was on his lunch break trying to find a plumber, Marcus's portfolio, with his little monthly contributions, just quietly grew to about $76,000. And how many hours did he spend managing it? Exactly 0. No emergency calls, no stress. Okay, let's fast forward a bit. We're at the 10-year mark now, and this is where the race gets, well, surprisingly tight. We've got two of the most powerful forces in all of finance going head-to-head.
So Jake's superpower? It's leverage. I mean, think about it. He used 50 grand of his own money to control a $250,000 asset. So as that property value goes up, he gets all the gains, even the gains on the bank's money. It's a huge, huge advantage.
And then there's Marcus. His secret weapon is compounding. You know, that magical thing where your investment earnings start generating your own earnings. It's kind of quiet at first, you barely notice it. But over time, it just accelerates into this powerful, unstoppable curve of exponential growth. So after a full decade, where are we? Would you believe it? It's practically a dead heat. Jake's equity in his now appreciated property is sitting around $175,000, and Marcus's stock portfolio? It's worth about $170,000. It's crazy. Despite their completely different journeys, they've ended up in almost the exact same spot.
Okay, here we are. The 20-year experiment is officially over. It is time for the final weigh-in. Let's look at the numbers and finally declare a winner. And after 2 full decades, the final result is in. And you might not believe this. Their net worth is practically identical. Jake has built up about $450,000 in equity and cash flow. Marcus, he's got about $440,000 purely from compounding. It's basically a statistical tie. I'm guessing that is not the outcome most people were expecting.
But here's the thing. That final number doesn't tell the whole story, does it? Not even close. I mean, Jake worked for his money. He managed debt, he dealt with tenant stress, and his entire investment was tied up in one single illiquid asset. Marcus? He just waited. Sure, he had to endure some wild market swings, but his asset was totally liquid, his risk was diversified, and he enjoyed complete and total freedom.
So to really get this, we have to look beyond just the final balance sheet. This is really about the fundamental trade-offs, the pros and cons of each path.
Look, the case for real estate is strong. There's no denying it. That 5-to-1 leverage Jake used, a regular stock investor just can't replicate that easily. Plus, he got some major tax breaks, like depreciation. And let's be honest, that mortgage payment is kind of like a forced savings plan, building equity month after month.
But then the case for stocks is just as compelling, isn't it? It is truly passive. It's incredibly liquid. You can sell your entire position in seconds if you need to. It's simple to diversify. And maybe the most important part, there are absolutely no 2 a.m. phone calls about a clogged toilet. That freedom? It's undeniable.
So, after all that, after 20 long years, who's the real winner? Well, I'll tell you. It isn't Jake, and it isn't Marcus. The real winner is someone else entirely.
See, the real trap isn't picking the wrong investment between real estate and stocks. The real trap is choosing either one based on a headline or what some guru told you, without actually understanding all the costs. I'm talking about the cost in time, in stress, and in actual dollars. The smartest investor, they're not on Team Jake or Team Marcus. They're on the team that actually runs the numbers.
So the next time someone tells you that one investment is just better, you'll know what to ask, right? Ask them, hey, did you include everything in your calculation? Did you include the repairs, the vacancies, the late-night phone calls? What about the sleepless nights during a market crash? Because the only answer that really matters is the one that includes everything.